Was Lehman too big to fail or too risky to save? Lehman Brothers was a major Wall Street investment bank founded in 1850. By the mid-2000s, it was one of the four biggest U.S. investment banks, with assets approaching $680 billion. At its peak, Lehman was deeply embedded in the global financial system. Why it collapsed? Lehman ran with extreme leverage and concentrated exposure to mortgage-linked assets, especially subprime-related securities. When the U.S. housing market turned and those assets rapidly lost value, Lehman couldn't raise enough capital or secure a buyer. The U.S. Treasury was unwilling to provide another bailout in that political moment. And on September 15, 2008, Lehman filed for Chapter 11 bankruptcy, widely cited as the largest bankruptcy in U.S. history at the time. The announcement triggered market panic. Global credit markets seized up, investor confidence collapsed, and headlines framed it as the defining shock moment of the 2008 crisis. The event became a touchstone for too-big-to-fail debates and accelerated sweeping regulatory reforms. The imagery of Lehman employees leaving offices carrying cardboard boxes became one of the most recognizable symbols of the crisis. CEO Richard Fould's public and congressional appearances were closely scrutinized and widely circulated, feeding a broader public narrative about greed, risk, and accountability. Lehman's fall also fueled books, documentaries, and films, e.g., Too Big to Fail. What happened next? Barclays acquired key U.S. operations while Nomura bought parts of Lehman's business in Asia and Europe. The holding company remained tied up in legal and liquidation processes for years. Lehman's collapse reshaped global banking rules and permanently changed how markets think about liquidity risk, leverage, and systemic contagion.